Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, they've been propping up this Ponzi. It's not working any longer. We're going to show you exactly why that is. You're not going to want to miss this video. Let's dive in.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes. And if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. All right, Bob, just when you think they couldn't throw any more things out the window, like the kitchen sink, they found another kitchen sink.
Yeah, it's just amazing because people don't see these like liquidity injections. So people just kind of stay kind of immune to what's happening. But since basically 2 weeks ago, it started to fall apart because of the T-bills are no longer being issued. So they're stuck with, do they have to now increase the distressed asset usage, right, to keep the Ponzi going? But that's not going to work, Phil. And the third thing is that we have $9 trillion of debt to refinance between now and the end of the year. $2 trillion in new, $7 trillion in old. And they have nowhere to go with this. The Fed is not increasing quantitative easing. The banks can't absorb any more paper, and that means interest rates are going to go up. So I think we created a perfect storm here. And Phil, I'm going to let you just speak to this chart. But this is one of the emergency measures. Am I not right?
Yeah, this is a BTFP chart, which stands for Bank Term Funding Program. And this, spiked up in March, right? This was because of the banks. So the problem with the banks is that they had all of these bonds. And the problem is that it's fine if you have bonds in a rising interest rate environment if you don't have to cash out early, because if you hold to maturity, you'll get all your principal back plus your interest. Well, when you get into financial distress, all of a sudden you may have to cash out those bonds. Oh, and by the way, now their face value is been decimated because the face value is down from, so far from when you originally bought it because the interest rates have been cranking up. So, interest rates have an inverse relationship with the face value of bonds. Value of bonds goes down, the yields go up. So the Fed essentially caused them to have extreme balance sheet duress. Now, like I said, that's normally, you can get away with that if you hold the maturity, but these banks started getting in trouble. And that's the problem when you run into the situation, is that you have no room for error. So if you start running into a situation where you need to start liquidating assets, this becomes a massive wildfire really quick. So the Fed, in response to that, created the Bank Term Funding Program, which essentially was a window to create money out of thin air to give to the banks. So we're perverting the natural course of markets where, normally if you have an imbalance, you're going to fill that imbalance usually with a drop in the markets, but they go ahead and they paper over that with, money created out of thin air. Ultimately is inflationary, the one thing that they're saying they're trying to combat, right? So, but this is a bigger issue, so they're going to sweep it under the rug, so to speak. That's how important this was from keeping everything crashing, and they had to emergency, create this window. So that's what this is representing. So you didn't have anything before, and now you've got it all of a sudden up in the air. And I'm gonna skip forward to that Fed credit chart, just kind of give people an understanding of the implications of this. And that is, here is the green is S&P 500, blue is that. Essentially, it's the emergency credit line for the Fed. So you've seen it spike here a few times on this chart. One is in 07, 08. One is in the COVID dump. And then more recently here back in March with the Silicon Valley Bank crisis, which obviously was more than just them, but that's what it's known for. So, but you can see when this thing spikes, it means there's extreme duress in the system. I mean, obviously in 08, they finally opened it about halfway through the bear market, and then finally the bear market crescendoed and S&P 500 went under 1,000. I mean, major stuff, right? COVID, you guys remember how fast that crashed and it spiked there. Here we spike, Bob, and all of a sudden the market's just shrugging it off.
Yeah, and if you go to the chart that I sent over to you, and this is why. We have now record zero DTE. It's basically It's like somebody pumping up a balloon constantly. And here's the issue, Phil. They have to keep putting more and more and more risk into the system to maintain the Ponzi from collapsing. But it's not gonna work, because at some point somebody's gonna stop participating in this. And as you start losing open interest in this stuff, then you're gonna see massive selling. And by the way, this is how the flash crash happened in 2010. I believe it was 2010, because they were pumping like this, a different kind of scheme. And people just walked away. There was no buyers. And just like now, there's no natural buyers. If we didn't have 0 days to expiration call options going, this market would be down 10, 15, 20% already. And so this is the pump, but it stopped working, Phil. And the other thing you noticed, oil's up 24% since June as well. So what's happening is people are recognizing that inflation's coming, and smart money is abandoning the high beta tech, and they're rolling into energy, which is what they call it. It's a natural rotation for the higher inflation environment that we're going into. They're protecting themselves, because we also showed you guys a chart. 15 months after they start raising rates is when it starts to bite, and we're there. So we have a perfect storm in front of us, Phil, and they just can't keep pumping this stuff in, because, if oil gets over $100 a barrel, there's going to be alarm bells ringing worldwide, and it probably will precipitate a market crash versus a market correction.
Yeah, I totally agree. And I think that you can get away with this leverage stuff for so long, and then you, like you said, because you have a lack of natural buyers, so there's only so much that leverage onto leverage can do. And then as history usually proves, you get a bit of an implosion as the thing it's just like another Ponzi. It just implodes and the house of cards falls apart. So guys, what do you think? You think we're crazy, or do you think this is just another mini Ponzi inside of a big Ponzi that ultimately is going to pull back? Let us know your thoughts. Otherwise, guys, thanks for watching. Please hit like and subscribe. Check out our specials at tradegenius.co. We'll see you on the next video. Take care.
Trade Genius.